3, 2,
How many
1.
jobs? How many jobs you got over there, Conan?
Bam. I hit the buttons right though this time.
Yeah, I know.
All right, guys. Welcome to the weekly update show.
It is November.
It is, man. First day of November.
First day of November. We got a huge week coming up. Being the election and all that. Right?
I was like, what's going on this week?
Yeah, this is a big week.
Yeah, I've stayed so far out of that stuff. I mean, I'm obviously voting, but I just tuned out. Well, call me when it's over.
We are not talking about the election today.
We can't.
On the show.
Because Facebook won't let us.
Oh, well, there's that. That's right. I forgot about that.
No, it's not that they won't let us. If anybody knows that, like, Facebook basically put a kibosh on anything to do with the elections during a certain time frame. And they're going to continue it on past November 3rd anyway, whatever. So we can't.
That's
our
right.
Our last show got kind of suppressed.
Yeah. When you get a chance, go back and look at the last show because it was a good one. And we were hoping to use it to kind of advertise out and stuff going into the election season. But Facebook
said no.
Not like it. And it was not political, obviously. It's talking about the charts on every presidency going back to Reagan.
Yeah, it's just historical.
It had nothing to do with politics. It was charts of what happens when there's an election cycle.
Yeah, they said no nicely.
They did.
They wrote me a nice email.
And they said no. Yeah. All right, good for them.
What do we got this week, man?
We're not talking about elections today.
Or Facebook.
We're going to start with so the quotes that I had been doing. The ordinarily there are some staunchy old dude that. Some historical personality, whatever, that I've been taking these quotes from. But I figured that today I would go a little more millennial. So, Alexa von Tobel, I'm not sure how to say that. She is a 37-year-old Jacksonville, Florida native. Harvard undergrad, followed by Harvard Business School, and then founded a company called LearnVest. LearnVest was on the leading edge of digitizing the financial planning industry. Ultimately, her and her company got bought out by Northwest Mutual Life Insurance Company in 2015. Then in 2019, she launched an early-stage venture capital fund called Inspired Capital. She's also the author of the New York Times best-selling book, Financially Fearless. So her quote is a good way to start the show because of what the focus of the show is going to be about. So a good financial plan is a roadmap that shows us exactly how the choices we make today will affect our future.
That's deep.
Yeah. I mean, it's not. It looked kind of obvious at first, but then when I looked into her story, I kind of liked it, so I wanted to do that. But what we're going to get to today, basically, we're going to do the talk about the market this week and do the charts and all that. But the main focus of the thing is going to be perspective, right? We're gonna look at why it's important that you have a big picture and sort of a medium term. Big picture meaning time, right? Yeah. Big picture. So monthly, each tick is a month. Over, in this case, we're going to do 14 years, and then 3-year weekly, and then 1 year daily. You gotta be able to know where you are in each of those time segments, right? Because it puts your losses or your gains or whatever in perspective. It's relative to where you were before, right?
Right. Yeah.
So that's the thing. A financial plan, which in her case it's a literal financial planning industry, right? That's not what we're talking about here. We're talking about planning our TSP, right? Mm-hmm. Planning on making gains and minimizing losses in the TSP. So
it's our retirement plan.
It's our retirement plan.
It's not our financial plan.
Right. Two hugely different things. Yeah. But the roadmap that we're using is technical analysis, right? We got trend lines and moving average lines and Fibonacci support levels and all this kind of stuff, and they keep you on track. Basically, the big map, right? And so that's kind of the idea. We're gonna get into it, and I'll keep referring back to it. But that's why I pulled up that quote for today. The choices that we make today, based on how we use the map, will affect the future, and it's relative on on a time basis. So let's just keep on moving because I'm starting to lose track of myself here. Okay. So the market this week, we had an orderly consolidation that took us from the October high down to the 50-day moving average. That really began to give way on Monday, but by Wednesday, everybody knows Wednesday's gap down. It gapped down through the 50-day moving average, and that pretty much, that was it.
Yeah, I remember you. It was Monday morning or Sunday night.
Yeah,
we were watching. You were like, "Hey, this could be
Yeah.
it, right?" I mean, you have the line in the sand
Right.
on your analysis, your charts, and once it crosses that line in the sand, it's it.
Right.
Yeah.
So I think what we can remind me, we can look at it when we get to the daily chart, but last week we were above the 50-day moving average, but below the 10-day. We were right in the middle. And Monday, Tuesday, Wednesday this week, Monday we definitely dropped. We dropped below, and I think it reversed and closed like right on the 50-day.
Yeah, I think Monday and Tuesday, right?
Tuesday was it was called an inside day, so that was like also right on the 50-day, right near it. And then Wednesday it gapped down.
But it kept closing above it, which is the key.
Well, it was a little bit below it.
Yeah.
It was definitely a little bit below it. It was so close.
Yeah.
And this, the lines matter, but this is as much art as science. And if you're just a little bit, that's why we have that rule, right? That I hate rules, but let's just say we have this rule that says if it's above the 10-day, be in the stock funds. If it's below below, be out of it. If it's on there, give it another day, right? Essentially, that's what I was doing.
Close enough to be on the 50-day.
Yeah.
And the key is for people to remember when we say that, like if all things, were wonderful and we could move as much as we wanted to, right? And that's why it has a lot to do with why we recommend people move out of the TSP when they retire, at least a certain amount, if they can, out of the TSP into an IRA, because many IRAs are set up more flexible. You can do more moves, right? And so if you had the ability to do those moves, then you would you could go back and forth on the 10-day moving average is what I'm getting at.
Yes.
You could do that rule like all the time, just in and out, in and out, in and out. But we can't do that because we get 2 moves a month.
Right. We can't do it. Right. So, on Thursday this week, the 10-day crossed the 50-day. Definitely a bearish sign. The next possible support level really is the September low, which was about 3,200. But more likely than not, I think the market goes down at least to the 200-day moving average, which is right now about 2130. It's actually 2129.
And you got a chart for that?
Yeah, we'll see the chart for that. So I'd really be watching the major indexes, right? The Dow, the NASDAQ, and the S&P 500. All three of them are in a little bit of a different place in terms of the moving average lines. So definitely watch all three of them for support or failure of support at the moving averages. Okay, and then so we'll take a look at the charts that support all that. And the overall theme of the thing is going to be, like I said, perspective. Why examining multiple time horizons is so important to effective reallocation decisions.
Yeah, and I don't want to glaze past that. So if some folks who watch our show, they get into the charts, other people not as much, wait around or fast forward to this perspective piece, because we get a lot of questions. We get a lot of questions about, well, why did we just move out completely and take and lock in that loss? Right? Why did we do this? Why did we do that? Well, some of those questions are going to be answered in this discussion. So I know a lot of you out there have that question. Yep. So
that particular question is getting answered right now.
Wait for it. Yeah, wait for it, and you'll see it. All right.
Okay. So, because that's what I have in my notes, my slide notes, which unfortunately you can't see. We need to figure that out. So, before we get into all the charts and everything, this idea of locking in a loss. Okay. So, if you are not on, if you're not a subscriber to the site, and you did, we put out an alert on Wednesday, and by the end of Wednesday, we had locked in a pretty sizable loss. Definitely, it was like I mean, it was for us. It was only half because we were only half in the stock funds.
Right. I was going to say that we were only 50% in.
Right.
So our loss was less than someone that was 100% in.
Correct. And the S fund didn't do as bad as the C fund. So personally, I don't think it was a bad loss.
Yeah. Well, we know it's not.
Yeah. No, I know it's
yeah,
not.
we're about to explain why.
Yeah. So let's touch on this idea of locking in losses. Okay. If you lose 1% of your money, here's something I didn't ask you earlier, so I'll put you on the spot. You lose 1% of your money every day, right? How long will it take you to lose all your money?
100 days? I'm not a mathematician.
Yeah, I knew, but that's the answer that I expected and the one that I wanted, and I guarantee you 99.9% of people that are watching this show, that's exactly what they would say.
Yeah, because
it's wrong.
It compounds, right? It's not. It doesn't work. It's not that easy. It's not 100 times 1%. I know that, but I don't know what the answer is.
Right. So here's the thing, right? If you have $100 and you lose 1%, you have 99 left because the 1% of 100 is $1.
Yeah. After that, it changes.
After that, you have $99. So it's 99.9 cents is the 1%. It's not $1. So as you get lower, you go to infinity. Like you can never lose all your money. That's just an interesting little math.
It gets really close to zero.
It gets pretty damn close to zero. But that's the thing. So, and it works the same kind of way going on the upside too. But I just, that's a little math grenade to throw in there just to kind of, know.
But most people wouldn't think of it. So,
Right. You don't look at it that way. People are like, if I take this loss, I'm screwed. Well, we're going to show here that you're really not.
And it's important to point out that it's not that we're saying taking losses is okay or good. There's just at times they're going to be inevitable, and they work in your favor because you're not going to take more of a loss. And our number one rule, don't lose money. Right. You need the most amount of money in your account to grow and compound.
Right.
Okay, keep going.
Because that's going to be in here too. So you can never go to zero. Okay. If you have $100, because we're going to use $100 just because it's simple, right? You got $100 in your account. The market rolls over, and it's down 5%, and you say, "All right, I've done my analysis, and it looks to me like the market's going to continue lower. I'm going to lock in that 5% loss." Okay, so I lock in that 5% loss off of my $100. How much do I have in my account?
Got $95.
$95, perfect. How much do you need to gain from that 95 to get back to 100?
Theoretically, 5%.
5%, but it's 5% of 95, right? 5% of 95, so it's actually 5.26%.
Right, to get back to 100.
To get back to 100. Okay. So now let's say you have that $100 in your account. The market tanks, but you don't sell. Okay, you ride it up and down because the market always goes up. You ride it up and down. So let's say the market. You got out at a 5% loss, and the market continues down to a 25% loss. Okay. How much is in your account if you rode it all the way down?
If I rode it all the way down, I got $75 left in my account.
Right. So if you have 75 you've lost 25%. It's paper loss. Right. Before anybody freaks out that this isn't, it's not a real loss. You have not locked it in.
Right. You didn't lock it in, but you still have only $75 in your account.
That's right. The value of your account is $75.
Right.
How much does it have to recover, the market, to get you back to your $100?
I mean, I think it has to go back up 33%.
It does. Right. 33%.
Yeah.
So it came down 25%. Yeah. But to get back up to where it was, it has to increase on the lesser dollar amount by 33.33%.
To get you back to $100, where you started from. So this could have taken a day, this could have taken a week, could have taken a month.
Yep.
Right? It does. You don't know. The market does what it does. Right. So you wrote it down 25%. Now, because you only have $75 in there, it's going to take you 33.3% to get back to 100.
Correct.
Gotcha.
Okay.
So that's the buy and hold strategy, which we don't recommend.
No.
Let's talk about the other side.
If you locked in your loss at 5%, you'd have $95 to invest at the market bottom versus the 75 if you had not locked in those losses, right?
Right. The other person is starting at $75.
Right.
We got out at 5%. We saw it on the way down. We got out.
Yes.
Now we're sitting at $95.
Right. And they're sitting at $75.
Right. And we see the bottom. Through a technical analysis, we see the bottom. We're confirming it.
Yeah, we're not that far yet.
Okay.
I'm trying to like walk it through there.
All right.
If the market recovers like the 33.3%, like we said, the person that wrote it down and back and up would be back to their $100. The person that locked in the 5% loss early on could be at $126.64.
Because they went from 33.3% up from $95.
95, right. Now, the further the market goes down, when you're not exposed to the losses, the more gains you could make, right? When the market recovers. The key is getting back into the market as close to the upturn as possible, just like it was the key to get out of the market as close to the downturn as possible.
Right. And that's why we used 5%, because it's highly unlikely you're going to nail it at zero, right? We're at the exact time that
you're not. There's nothing to nail.
Yeah.
You don't know until it's already happened.
Right.
You will never, at least not the way I do it, you will never get out at the top.
Right, because you don't have a crystal ball.
Exactly.
So it told you it was going down. You get out, but you took the 5%.
Took the 5%.
Okay, now we're down at the bottom.
We're down at the bottom. Okay.
And
so you could be at 126.64 if you hit the bottom exactly, right? But so the further the market goes down, the more you would make, because you're at 95 versus whatever the lower number would be as the market continues down. The key is getting back into the market as close to the turn up as possible. So much like locking in a minimal loss at the top, which 5% is no joke, but it's a relatively minimal loss at the top. We don't get all the gains coming off the bottom, right? So let's say you missed the first 5% of the gains when the market rebounds, right? You locked in not getting the potential, the first potential 5% gains, okay? So same as locking in the 5% loss on the top, we locked in not getting the 5% gains on the bottom.
yeah, because
right?
we were watching to see what happened, and we got to wait for it to happen.
Yes, right. Exactly right. So in the end, the person who rode the market up, person who rode the market up and back down has his $100 back. Okay? The person who locked in 5% loss at the top and 5% loss of gains at the bottom has $121.89.
So they both started with 100.
Yep.
One rode it up and down without making any changes.
Right.
They're back to $100.
Right.
And had a lot of stress.
Yeah.
The other person, $121. So they got
Took a 5% loss in the beginning.
Right.
Shit, I hate taking losses, but I'm going to cut my losses short and I'm going to take a 5% loss, which is no joke, right?
Right.
So now I get $95. Okay. Then the market continues down 25%. Yep. I didn't get in exactly at the bottom. Shit, I should have gotten in at the bottom. I didn't. I missed it.
Right.
But I'm getting in now because I can see that across the trend line, whatever, I'm getting in.
Right.
The market moves back up to where it was before.
You're sitting at $121.
I'm at $121.89.
I got $100 because I bought and hold.
Right.
Market always goes up.
It does always go up. Sure. It's but now we're up 21% higher than you are.
Right. Now let's put that into some more perspective, right? So most of us in the TSP, unless we started today, right? Let's just say $100,000, right? Because people have a lot more, some people have less because they just started. But let's just take it from $100 to $100,000.
Yeah.
The person that basically followed the rules that we're doing, right? Which we're not the only ones that follow these rules. We're one of the few people that do it with the TSP.
Right.
Right. But following our rule set, based on what you just explained, we're up $21,000 if you got $100,000 in your account.
Right.
The other person is back to $100,000, starting from scratch, just where they were at the beginning of all this. That is the important piece for all of our listeners and all of our members and everybody
Yeah.
to let soak in. We always get this, we mostly get people who don't believe in technical analysis.
They don't know. They don't understand.
Yeah. They're like, oh, you're going to take this loss. You're going to lock in the loss.
Yep.
Yeah. But because it's going to keep going down. And I don't know when it's going to come back up, but when I figure it out, when it tells me it's coming back up, right? Because it crossed the trend lines, it, met all the indicators that it's coming back up. Not a gut feeling, not a crystal ball, but it says, hey, it's on the rise. Jump back in.
Yeah.
Following this particular rule set, up 21,000. Would you rather be up 21,000 or be back to where you started? That's the question.
Yeah. I mean, this is just an example, right? If the market had gone down in this example only 10%, I mean, I'd have to do the numbers, but if it went down 10% and we took the first 5% loss.
Yeah, obviously the numbers change.
Yeah. But I mean, it could have, but the other key piece of this is you take the 5% loss, right? Yes, you are locking in, quote unquote, locking in your losses. However, you're also locking in the inability to take any further losses by law, because the G fund is
G fund
by law, right? And the G fund right now is 0.75%. It's almost zero, but it is a little bit positive.
But it ain't zero.
It ain't zero,
right?
Right?
Yeah. So that's the part I think that just we have found over the years of doing this, and even before I came on board with Jerry, was that's the hardest thing for people to wrap their head around. Is this whole idea of, oh crap, I got out. Now I really did lose my money. I can't get it back. Yeah, you can. What you did is saved it, right? You saved it from harm, right? And you wait till you can start getting gains again. Yep. And sometimes that example is going to be bigger ups and downs. Sometimes it's going to be smaller ups and downs. The point is, be out of the market when it's going down, be in the market when it's going up. And at the end of the day, don't lose money.
Right. And it doesn't always work. We don't... you do take actual losses in this. Nobody's methodology is 100%.
Yeah, I haven't seen anybody that takes zero losses. Yeah. The other thing to point out is that over the last 20 years, the largest upturns and downturns you've been able to call because the charts don't lie, right?
Right.
And you can go back and look at it and decipher it any way you want to. The chart told you. You can see it. Like, if you understand technical analysis, you can see, yep, right there. That's when it was going to happen. And the key is like knowing when that is, confirming it, and then getting out or getting in.
Yeah.
That's it. That's what we did Wednesday, right? I mean, you started looking. I remember your phone calls.
Yeah.
He's like, there's an alert coming. There's an alert coming. And I'm like, okay, well, we're doing the migration. Can you hold off? He's like, the market does what the market does,
me
man.
What to do.
I'm like, Yeah. So we did the alert. And it is what it is. The market was in a downturn. Time to get out.
Yeah. So I just want to make sure I get this little, not a plug, but here's the thing. I've seen a lot of stuff on Facebook, and we will continue to see it. But this concept of what we're talking about, it's not conventional thinking. It goes against what most people believe that they know to be true about investing in general and TSP specifically. And the line is always the same thing. You can't time the market. We are not trying to time the market. We're trying to manage downside risk and maximize upside gains. The difference is not just nuance. It's math.
There you go. I was hoping you were going to say that.
Yeah.
Because, when you say that, what was the terminology you used? We're not timing the market.
We're not timing the market.
We're managing downside risk.
Manage downside risk and maximize upside gains.
Right. And I understand that. I know it's to be true, right? But it kind of sounds a little, like
it's hocus pocus. But
right.
we just did it with a $100 account, and we showed the whole thing.
But at the end of the day, it's freaking math.
Yeah.
That's why I bought into it years ago. This theory and philosophy and the way the process, because you can't. It's very hard to change math.
Yeah.
Right. It just is. So if you find that this, mathematically just is consistent and it works, like it is what it is. So you either believe in technical analysis or you don't.
Yeah. I mean, I hate the word believe, but you can see that it works,
right.
or if it doesn't work,
maybe
you
it's
find
trust.
a methodology
maybe
that
it's
does.
Trust.
Yeah. Trust is probably a good one.
Yeah.
And it's really trusting in your ability to use the technical analysis tools when the market tells you what to, that you have to make a move. Like that's really what it comes down to. The tools are the tools, and we talked about the ability to use the tools. Applying the tools without an emotional piece, that really, when you drive right down to it, that's what it is. That's
what I was waiting to point out, is one of the reasons why I bought in early to your philosophy was because I learned through getting to know you, obviously, but I time and time again, proof positive for the last 17 years I've known you, you have a uncanny ability to not put emotion into it. And you're not going to find many investment advisors that have that. The ones you do well, yep, because you don't worry about the fear of missing out, right, the all that stuff. Take the emotion out and look at the chart. Chart told me what to do. Right? It's like right, me telling you on Monday, please don't do this. We've got all this stuff going on with the website, and you're like, bro, I don't have any control. Right? It's the market, right? That's it. That's the reality. Is it's doing what it's doing, and we have to react to it. Yep. We can't predict.
That's right.
We have to react, and so that is not market timing.
No, we're
market
responding
timing
to what the market
would be
did.
You thinking on Friday, oh, I think this is going to be a downturn.
That's right.
And then telling everybody, hey, go 100% G. You don't know. You got lucky on Wednesday and it happened, right? Or Monday or Tuesday, Wednesday, right? It happened. That is market timing. Market timing is not waiting till you know, right, and then reacting to it. Right. That's why that's why you got to take that, X% loss.
Yes, you always have the loss.
You have to wait to know.
Yes.
Because you have to wait till the market did it. You can't predict it. Right. We're not predicting it. We're not timing it.
It's funny because as you say that, it kind of made me think, what exactly does it mean, the idea of market timing? Like, I understand the idea of like predicting, because like we talked about earlier, the Elliott wave stuff, there are tools that you can use to try to predict, right? Elliott wave says that the 5 steps should go up and it should hit this price level. And when it does hit that price level, I'm getting out because Elliott wave says that that's the top and it should come down from there. That's not, market timing. It's utilizing a tool to get out at a certain level, and a lot of people do that. So I guess I'm trying to understand what exactly this term market timing actually means.
Yeah, well, I have been in that camp that thought what technical analysis was akin to market timing, meaning like there's some magic way I'm going to understand that now the market's going up. Well, that's not really the case. What you're seeing is the market just went up. Right. And based on historical data and indicators in the charts, and again, what you're going to, I think, talk about more is like, yeah, we look at 3 months. We also look at 9 months. We look at 1 year. We look at 10 year. We look at all these different variations, weekly, daily. Why? Because then when you see all of those trends match up. Yep. Well, there you go. It's confirmed that the probability.
Yep.
Is that it's going to do X. Yep. Now. It's
not for sure.
Possibly, and it could do something else.
Yeah, and if it doesn't, right? So why did we wait until whatever it was, Wednesday or Thursday?
Wednesday, yeah.
For that gap down. Why did we wait for the gap down to put out the alert? Because if it had found support at the 50-day
bounced off the 50-day, yeah,
the alert would have been the other way.
Yeah, more in. Let's go all in.
Yeah.
Yeah, I remember you talking about that. You're like, man, I want it to go.
I had a direction I wanted it to go, and it was not down.
And it didn't matter, right?
Right.
It didn't matter what you wanted.
Right.
It didn't matter what I wanted. That's what happened.
Yeah.
Yep. And so we had to wait for it to happen. And once it crossed that threshold, it's like, yep, there you go.
Yeah, that's it. You're
if
out.
it had bounced off that and then kept rising, we might have missed the first 5% of, because we were 50% in. We were 50% in already. But we might not have gone 100% in for a day or two just to make sure.
Sure.
Because you want to make sure and look at the data. Yeah. All right. I think we've probably beaten this up enough.
Yeah.
Hopefully now. So I know it would have been, I know the first thing we're going to get is, hey guys, it would have been useful if you had some kind of graphic. We didn't have time to put one together for the show, but we are going to put one on the website because we get this question so much. Yep. So we're going to create a little infographic of some sort that will show you this scenario and be able to explain a little bit better like why it's so important to get out, even if you've taken a little loss. And because this plays into, correct me if I'm wrong, Jerry, so we'll also get people that, let's say they join Monday. they join our member, or they're watching the show and they find out we went 100% G, right? Because we're saying it out loud, even though, our members knew on Wednesday.
Right.
So right now you're taking huge losses. And on Monday, somebody joins and says, well, what do I do? Do I, I'm 100% in C fund right now. I'm just making it up. And they're like, well, what should I do?
Right.
Well, I don't know. You got to do what you got to do for your personal risk tolerance. But on the flip side, this is Conan speaking, right? If I look at that scenario and I go, okay, if I buy into this theory, just get out, right? Don't take any more losses. Now, what we know is the market may very well turn the next day. You have no way of knowing. That's trying to market time, and we're not doing that right this minute. As we speak, the market was at a place in a downturn, and we wanted out.
Yes.
Monday, when the market opens back up on Monday, that could be a very different scenario. So why I bring all that up is, you did a blog post called "It Depends."
Yep.
That is the answer. Like, it depends on a lot of things. It depends on your risk tolerance. It depends on where you're at and what you're trying to do, and a whole bunch of factors. The bottom line is understanding this. We've got folks that really have bought in, right? And they also kind of make moves a little different than you. Right, and they might jump in a little faster than you,
sure,
because they're a little riskier.
Yep.
Right, you're risk averse.
Yeah.
So, right, and I'm risk averse. I don't want to lose my money. I want to keep it. Some of our friends that are members aren't that way, right? So they may jump in a little faster or jump out a little faster. Right. I bring all that up just to point out that if you're not exactly matched up with us, probably, I don't know if there's a percentage, 70-80% of the time we say just get linked up with us, right? If you're following what we're doing.
Yep.
If not, wait for the next one.
Yeah.
That's really the only two options you have. Unless you're really into technical analysis and you decide you're going to take a different route.
Sure.
Yeah.
It's just fun. There are guys that do that too.
Absolutely. Yeah. I mean, we do it, right? I mean, we have memberships to other sites so that we can track what other people are doing, because all of us are validating our decisions with other people's information. Right? At the end of the day, you know what you're going to do, Jerry. Like, I know nobody's going to change your mind because you've got your rule set.
Right.
But that doesn't mean you're not going to listen to what other people are saying.
Oh, yeah, absolutely.
Exactly. And so if we have people that are members not to make the exact same decisions we do, but validate their decisions off what we do, which is probably more along the lines of what we're hoping people to get to, is that we help you, educate you.
Yes.
So that you're really doing this, because it isn't that difficult.
No.
It's difficult to do what you do, which is spend most of the day looking at the market and when you can, and looking at charts. And a lot of people just don't.
Honestly, you don't have to. I mean, really, I mean, I just geek out about it. That's just my thing, right?
Yeah, but you're also adding more information to the pot that way, right? So you don't just look at a couple indicators; you're looking at 50. Yeah. Although you might only talk about 5.
Yeah, if I wasn't doing the show, we weren't doing this business, I would look up at the chart, probably 100 times a day on TV as I'm walking by it in the office, right? But through the airport or a hotel or wherever I'm at,
because you're going to do it anyway.
But I would look up like that at the chart, and I that's it. That's all I need to process all this stuff. And at the end of the day, I might do it on my phone, whatever, just kind of get an idea of where I think I am, because I already know my lines in the sand and all that. I don't need to do all this stuff. This is an educational site for people to learn how to do it.
Absolutely, yeah. That's true. That's good to point out that other than this, what we do here for you guys, Jerry wouldn't be drawn on charts like he does. We're doing it because we want you to understand how to do this. And, we've just been talking about, we're going through this whole process of certifications and registry, all this stuff. And I don't particularly need to do it, right? But I'm doing it because I want to learn more so that I can do it on my own, right? Because I'd love to play into some other things besides the TSP, right? And so if I learn enough, I can do that. Now, it's my personal risk. It's my money. I'm not hurting anybody. But the point behind that is that's what we're trying to get across to everybody here, whether you're a member or not, is you can learn enough, because the TSP is not really that difficult.
It's 3 stock funds, a bond fund, and a savings account, a money market.
Yeah, we always say it's 5 funds. It's really 3 that you're really, really watching.
3 stock funds.
Right. And so, anyway, let's move on and take a look at the charts. What we got next?
Let's see where we are.
We got to get an infographic for all that. So that people can look at it and consume that a little faster.
We get an infographic coming up, but it's not for that, unfortunately.
Right.
Okay. So
there's an infographic.
Yeah, we talked about the megaphone pattern over the last month or two, for probably, last 6 months really. This megaphone pattern has been developing now for quite a while. And just in case you think that I made up that idea of a megaphone pattern, I did not. There's this infographic is from eLearn Markets.
And you're going to zoom in a second, right?
Yeah, I'm going to zoom in. But you know what? Let me just do this first, and then we'll go back to it. Here's what it looks like in real life. Okay, this is that's
what's happening right now.
This is happening right now. Now, this is the bearish scenario. We're going to talk about that. The line at the far right with the arrow is my line.
Oh, okay.
So the bearish scenario, obviously the market going down. That's one of the possibilities. But this is the way the pattern, the megaphone pattern looks right now. These are the ideals. Okay, so here's the first thing, right? This looks a lot like our megaphone pattern, number one, right? The market came up. We got a 1, 2, 3, 4, 5. And right now, let me go back to this for a second. We are basically right there, right? So the question is, we've kind of gone, that's almost the exact pattern that we're in right now. Now, except that, our pattern is actually ours actually looks like that right now.
Because we just had that drop.
Because we just had that dip. This is virtually exactly what ours looks like right now. So this is a number one is bullish, because the expectation is that now that we are outside the pattern, north of that upper trend line, the line the price keeps going higher.
We've broken the megaphone.
Yeah.
Yeah.
So that's the bullish example of how it would go. That's not what we have done.
Yeah, no, I'm waiting for the ball to drop.
Yeah. So if you look at number two there,
what we're doing.
Right? You look at number two. This is actually a bearish example, but if you look at from where it says 4 here, down to 5, that could be our next move down.
Right. That could be that leg you just drew in.
Yeah. Yeah. So,
which is not what we're hoping for.
No, not what we're hoping for. And so there's only two possibilities.
Up or down.
Up or down. That's all there is. So
or sideways. There's a little bit.
It's possible, but when you look at these megaphone patterns, it doesn't really go sideways. You give a higher high, lower low, higher high again, lower low again, and at some point, the pattern changes. And when you can identify that change in the pattern, that's when you want to make a move, right? Mm. So number 3 is an example of what it would look like in real life. If we get that gap down, if we come back down to the lower, megaphone line, we're down at like 2,200 in the S&P, so it's real bad. And if it breaks down below that, it's really bad. It's going to
get worse. Yeah.
So that's like the depression that Trump's talking about if Biden wins. I'm sorry. I wasn't supposed to say anything about politics today, but that's the idea that would happen.
Yeah, and politics aside, like a lot of people would try to say that, this is going to happen because of this.
Right.
It's going to happen. It's on its way to happening already. We just don't know what's going to happen.
Right.
Right. It's on its trend.
Yeah. I mean, the market's already rolled over. Right. So this pretty much sets up Trump and Biden to say that either they're responsible for the rally that will happen, or the other guy is responsible for the tanking that could happen.
Neither one of them have any impact on it. Generally speaking,
they do. It's just that,
there is an impact, not all inclusive impact. So right now, though, so what's 4?
Yeah, so 4, actually, this is kind of important because a megaphone pattern always appears after a strong trend. So the strong trend that we just had, obviously because we're looking at it on that chart, we've been going basically straight up since 2009.
Right.
So if it always happens after a strong trend, it's identifying a top in this case, not a bottom.
Yep.
So number 5, the failure of a megaphone pattern can also be traded, which is essentially our trade right now. We got out, right? We're gonna look at this, but we got out basically at that 5.
Where that little circle is.
Yeah.
Yeah.
I mean, we took a little bit of a loss, right? We didn't get out at the top of the 5.
Right.
We could have.
Better than taking 50% loss.
Yeah.
Which is potentially where it's headed.
Oh yeah. I mean, I haven't done the math honestly.
The
but
probability is high that we're on that downtrend.
Yeah, we're on a downtrend. Whether or not it goes all the way down to a new lower low.
Right. Now, if it breaks that and turns up again, and then goes through the megaphone, right? Goes through that line. Whew,
all back in, 100%.
Yeah. Then we're out, and we're out of the megaphone.
Yes.
Right?
That's the best possible case scenario right there.
Is that we do this downturn. This is basically it's the word is
no, you're right.
me,
It's either this is a bearish scenario or a bullish scenario.
That's it.
There's only 2.
We're waiting to find out.
We're waiting to find out, and we're not just waiting. We're preparing, and that's what we're going to get to. So now we just looked at. We're going to look at it again here. I think. There you go. A 14-year monthly chart, right? If we know that either it's going to go up or down out of the megaphone pattern, one way or another, it's going to go up or down out of that megaphone pattern. How do we prepare for that, right? Let me just do my notes here before I get off track. So the next 2 slides are the long-term roadmap. So we were talking about the roadmap, right? So this slide and the next one are really the long-term roadmaps, right? We can see the direction that we came from, right? It was back down here in 2009. And so this 14-year perspective is valuable from a long-term perspective, but it does not help with making reallocation decisions, right? The chart shows the near-term bearish scenario, okay, where the pattern continues. Because right now, if the pattern were to continue as it has, higher high, lower low, higher high, lower low, higher high, the next one is a lower low. So I can't remember which law of physics it is that the things in motion tend to stay in motion, right? That it's absolutely possible that we get down to 2,000 on the S&P 500 because that's what the pattern, a continuation of the pattern would result in, right? Doesn't mean it's going to happen, but you need to. But this part of the roadmap shows that that's absolutely a possibility. Right.
Possibility, not probability yet. We don't know enough.
We haven't gotten there yet.
We don't know enough.
Right. It's a possibility, but no, it's not a probability yet. So here's the bullish scenario. It's the exact same chart, but instead of a continuation of the pattern to a new low, at some point we get support and the market turns back up. Okay, that would be a change in this pattern that has gone all the way back to 2018. It would be a huge deal, right? It would be a very big deal if, say, we came down to some level, got support, and the market turned back around and exploded higher on big volume and all that. We'd be back in the races. Okay, so there's only 2 possibilities.
Which, if you looked at all the way back to 2000,
2009.
Yeah, 2009. That would be what the trend has been, generally up, right? It's been bullish. So if you look at all of that, you would think there is a possibility that it's
keeps
going
going
to
higher.
that it's going to do that because it's been doing it.
Yes, absolutely possible.
And if you really took that back, that chart, past 14 years, you'd see it even more.
Right, absolutely.
Because it's been going up.
Yep. So the bearish scenario over here is because like we talked about, this is about time horizons, right?
Mm-hmm.
This bearish scenario is bearish because the line that I drew what is it? This that represents a huge price loss for us.
Mm-hmm.
Was it 3,500 down to 2,000 is, I don't know, more than 30%. It's a huge, I have to get my calculator. It's a big loss.
Yeah. We don't want it.
We don't want it. However, in the longer term time frame, let me get out of this. In the longer term time frame, wow.
It's not cooperating with you.
No.
Your magic pen.
Okay. If it comes down, continues the pattern, and hits the lower trend line, the next move from there is up.
Yeah. So it's huge gains. The idea would be take as little bit of a loss as possible on that downturn, which is what we did.
We are in the G fund right now.
Yeah. So what we're doing is waiting for it to bounce off that. If it does.
If the bearish scenario happens and we lose 30, 40, 50% or whatever down to that 2,000 level, then we have we have a ton of capital to throw back in when it gets down to that line.
Right. Whereas the people that wrote it down aren't going to have a whole lot of capital.
Well, you're going to have had that 40, 50% loss.
And then you're going to have to wait till it gets back up to get back to flat.
Right. That's right. So this is only bearish in terms of the immediate time frame.
Right.
Right. This one's only bullish in terms of the immediate time frame. Right. So either the market goes up or it goes down, and we're within this this cone, this megaphone. Now, that's it. That's the long-term roadmap. So how do we resolve between the two possibilities? Because as we said, there really only is two possibilities. The answer is that we don't resolve between them, right? We bring the time frame closer and respond to what the market tells us to do. So it's almost like Waze sending you around traffic or construction that wasn't on your original map, right? You don't know. You can see the direction, but you don't know what the obstacles are going to be as you're progressing towards ultimately the direction that you're going to go.
Right.
So the 14-year chart here is the long-term roadmap. And as we drill down into the smaller time frames, Waze is kind of taking us around the obstacles.
Yeah.
All right.
You got to look at both.
Yeah. You start with the big one, and then you move in. So here is the 3-year weekly chart. Same thing we just looked at. You can see that you get the high there in January 2018. Then the October high is higher. Then the 2020 high is higher. And we have this 2020 high is higher, right? We also have this low right here. This low is lower in 2019. This low is lower in 2020. So you get the megaphone. So if we drill down from the megaphone, this weekly chart is the most important chart in the slide deck, because it shows the megaphone pattern, right, as well as the possible support levels. We got 2 different moving average support levels that are possible and the Fibonacci retracement levels, right? So this is where you're going to apply like your personal risk tolerance and start to make some strategic decisions about the next, or what your reallocation possibilities would be, right? So if it's me, which it is, I'm looking at this chart.
If I was doing this,
I would look at this chart and I would say, okay, I locked in my losses / locked in my gains. You can look at it however you want, but I tend to look at it as I locked in my gains. So I'm looking at the market to come down at an absolute minimum to the 50-week moving average. Absolute minimum.
Is that 50-day or 50-week? Oh, this is weekly.
50-week is
weekly. Yeah.
It's weekly, so the 50-week moving average is the 200-day moving average, basically almost the same. Right. Yeah, that's the other thing that gets a little bit complicated. The 14-year chart was monthly. Each tick was a month. This is a weekly chart, and then we're going to go to the daily. And so, yeah, you got to, part of this is getting your mind around bringing the time frames in. You know? So on a weekly basis, at a minimum, I'm looking for, or I shouldn't say at a minimum. It is at a minimum, and the first possible support level is that 50-week moving average. In terms of moving averages, the next one is the 200-week moving average, and you can see. So we could get support there at that 200-week moving average, just like we got it back here. I mean, right on it at the end of 2018, right?
That's where we would be if we took those big losses we were just talking about.
Well, that would be the bullish scenario,
right?
So we're going to get the losses one way or the other.
Yeah.
Right. So let's say we do come down. You know, the moving average line continues out, and we get down to right here, which coincides with the 50% Fibonacci retracement and the 200-day moving average, and it's at, what is that, 2,900. Let's say that's where we get, right? That's basically where we would be right here.
Yeah.
So all we're doing is drilling down the time frame,
Zooming in,
right? Zooming in and zooming out, kind of thing. So at a minimum, we get down to the blue line, the 50-week moving average. A lot of times, the 50-week moving average is support, right? Not all the time. Failed, right? Most of the time it gets support at the 50-week moving average. If it doesn't, it mostly usually comes down to the 200-week moving average. Support. It doesn't always get support. Okay? There's no guarantees in any of this. There's probabilities, and if you're wrong, you're wrong. I mean, if you had bought in right there, you'd have done really well, right? Because you would have gotten this whole move. If you looked at that and you said, you know what, the next time it hits, so down here, if I bought it, like, you know, after it bounced off, then a couple months later, well, it's about a year later, you said, you know what, the next time it hits that 200-day moving, or 200-week moving average, I'm just going to buy it because I know it always gets support there. No.
Nope. Because now it's a megaphone.
Yeah, you just never know.
Right.
So you have to be willing to accept you're not going to hit the top and you're not going to hit the bottom.
Right. But once it confirmed it broke through there, that's when we got out.
Right. Well, we actually got out right there.
Yeah.
For a different reason.
Yeah, that's right. I'm sorry. I was looking at the wrong line.
Yeah. No, so actually, just in case people don't know, you can go back to the smart reads and see that. But we avoided this gap down and the whole move down. We avoided the whole move down, and I can't show it in this chart, but it was because it was for other technical reasons. I got out right there because we were really far extended off the 10-day moving average, and I I got out because
and
of that.
And that goes to where we're headed next, but you were drilled in even closer.
Yes.
And it broke a line that was a line in the sand.
It was a line in the sand for me on a daily basis, yeah.
Yeah.
So I didn't
obviously,
I had no idea that this was going to happen, right?
But you just keep watching.
Right.
And when it does what it does, it does. And then when it bounced off down there,
yep.
It's time to get back in.
Yep. That's it.
We didn't take that loss.
We didn't take any of that. It was a 34% loss.
And then
from here to here, it was a 34% loss.
Huge gain because we kept our money.
Yep.
We kept our $95 instead of the $75.
Yeah.
Back to the original.
I'd have to do the math, but so the market didn't, in this case, it wasn't, in this case here, it wasn't down 25%, it was down almost 35%. So, it's only that much more that you would have when you get back in at the bottom. Okay, so one more thing real quick about this before we get off it. The technical indicators, not looking so good. Definitely supports the idea that we're rolling over. Just another piece of confirmation. So the best case scenario, as I'm looking at this, is we come down to the 50 week. If it turns higher, great. We come down to the 200 week. If it turns higher, great. We could come down to the 38% retracement on the Fibonacci, the 50%, the 62%, anywhere in there, it could turn and go higher. If it does, awesome. That's the bullish scenario. If it breaks below this 62% retracement line, then it's coming down to test.
Probably going to get bad.
Then it's coming down to test this.
Yeah.
Could it do a double bottom? Yeah, great, whatever. More likely than not, if it breaks below the 62% retracement level, then we're down here somewhere.
The megaphone continues.
Megaphone continues. So, does any of that sound like timing the market?
No.
No, it's a whole bunch of what ifs, and you overlay the technical, the tools that we have, and
you do have to have your lines in the sand. And most people who do technical analysis are going to have a lot of the same lines.
Yeah.
Right. So that's the commonalities. Then it starts to turn into art, and it is art, but the art is also heavily. Risk plays your personal risk.
Yeah.
Weighs heavily into that art.
Yes.
Right.
Without a doubt.
So that's the other piece of that. So when we talk about science versus art when it comes to this, way of doing it, once you get into the art part of it, you gotta accept that that's your personal risk, your personal perspective,
right,
on the situation, right,
and the 2 moves a month in TSP.
Yeah, and the rule sets that you're dealing with, right. It might not even be moves; it might be fees.
Sure.
Right.
Sure.
We know that there are some 401ks that are just you get more than 2 moves a month, but the fees are astronomical.
Yeah.
Right. And so it's like, well, I don't want to waste all my money in fees.
Right. Right.
Then I ended up taking a 5% loss anyway.
Right. There are a lot of things to consider. There are, and that's just the way. It's the way it is.
Yeah.
It's how you play the
game.
But
most people doing this are TSP, so that's why we focus on that. Yeah.
Okay.
How many more slides we got?
Not too many.
We're at an hour.
We're definitely. Oh, we're at an hour. All right. Well, this now we're drilling in one more time to the daily.
I'm almost out of LaCroix.
So we're just gonna do the CS&I daily charts real quick because definitely we got what we wanted to talk about for this weekend, I think. But what we drill down to the 1 year daily chart, the perspective is actually quite a bit different. If we didn't understand the broader monthly and weekly patterns, we might not grasp what the daily chart is actually telling us. So, for example, does the chart support the analysis of the broader patterns, right? Are there other possibilities that you can see in the daily that weren't visible in the broader patterns? Okay. So here's kind of an example. It's the same as we were talking about in the weekly, right? So this is the daily, and like we said, the 50 week is the same as the 200-day moving average. So that's the first place that we would expect the market to come down to, right? what you don't see really in the bigger term patterns is you got 1, 2, 3, 4, 5. So that's an Elliott wave 5 steps up. And you got A, B, C. So you might have 1, 2. Right? And then that would mean 1, 2, 3, 4, 5. Right? You couldn't really see that perspective in the bigger chart, except, why isn't that erasing? Except that could be the thing that gets us to the bullish scenario, right? This is basically the same as this. We just said this was 1, A, B, C, 2, 1, 2, 3, 4, 5, and it keeps on going. So it's basically exactly what that is. Right? So we'll see. Basically, we're looking for the market to come down at an absolute minimum down here to that 3130 level. Okay. S fund had a higher high. So we got a lower high here on the C fund. We got higher high here on the S fund, and we also have a higher low. So the chart of the S fund is quite a bit different than the chart on the C fund, but the question mark here is does this 50-day moving average hold, that support level hold for the S fund? It doesn't look like it's going to hold, so it looks like S fund's going to come down here to its 200-day moving average also, right? I fund is not looking good. It's been in this horizontal channel now since June, basically. If you want to call it that, let's just zoom in here a little bit. It's been in this horizontal channel. We've been talking about it between 62 and 66, and it's now just had a couple days below that 62 level. The only saving grace for the iFund right now is it's at support at its 200-day moving average. So it's just a little bit below that support line on the horizontal channel, but it is at support at its 200-day moving average. So again, this is one of those like wait and give it a day and wait and see. If it closes below its 200-day moving average, there's no reason to be in the iFund whatsoever. So hopefully you guys get the idea of that. All right.
Questions. Anybody got any questions?
I don't have any questions. Do you have any questions?
If you guys have any questions watching the show, please reach out to us, either in the YouTube comments if you're watching this on YouTube, or Facebook if you're watching it on Facebook. Those are primarily the two places that people watch the show. I don't know how you'd watch it otherwise. Right. We really appreciate you guys watching the show every week. And if you want to do us a favor, share it.
Yes,
share it with your friends. It really helps us in the whole Facebook algorithm thing. If you actually hit the share button, share it with some friends or tag your buddies in it or whatever. But if you know somebody that is a military member or is a federal civilian, and you think this would be useful, which we think is very useful, to help you plan for retirement, then share it.
Please do. Please do.
All right.
Okay.
You ready to get out of here?
I'm ready to go. It's going to be an exciting week, so
let's play the music.
let's roll.
Bam.